Hello, welcome back. So we're here to talk about how does this even work. I tell you what, 11 plus years ago when I went through this is one of the most ambiguous, just abstract ideas of how money can work in one place and still work in another, two places at one time. And so I wish I had this visual. I told myself if I was ever in this position, I would create something where people just got it. So lucky for you, you're going to be getting this and you'll be well ahead of most people in terms of your understanding of how this works. So let's get going. First things first, we have to fund the policy. We pay a premium. Most people, negative connotation with the premium. This is not an expense though. This is an actual way for you to get money to the policy. Think of it as a deposit. So for those of you who are real estate investors, we're talking about money from your cash flow, money from your reserve account. That's typically how you're going to fund the policy. So it's not coming out of your discretionary income per se. It's more of money that's already flowing to an account already. It's just going into a different address. Okay, that creates cash value. I'm going fast because I want to get this around the 2-minute mark, so bear with me. This creates cash value. Think of this as like equity in your home, equity in a property. That's exactly what this is, but this is very special because it's multi-dimensional. Not only is it funding a death benefit, but it's also growing tax-free, it's growing guaranteed, it's growing regardless of what you do. How does that happen? Well, the insurance company has a general fund, which is a pool of everyone's money, which is matching your cash value. Your cash value serves as collateral. And because you're part owner of this mutual life insurance company, you get to take advantage of what's called the loan provision. Meaning, when you need money for whatever purpose, whether it's slow flips, whether it's rentals, or anything life-related, job loss, career, a car repair, emergency, you're tapping into the general fund. So you're not taking money withdrawals from the cash value because you're going to be in the same situation you've always been in, which is you're taking dollars out of circulation, dollars out of the ability to grow for the rest of your life. We want that cash, that equity, that cash value to grow for the rest of your life. Okay? So to do that, we're saying using money from the general fund, but pay it back on your terms. If you want to pay it back, guess what? You don't have to per se. The death benefit is out there. And so when the insurance company knows they owe that to somebody upon your passing, they take that death benefit, pay your family tax-free, minus any loans you had outstanding. So that's how that works. That's why they're not really concerned per se. This loan doesn't show up on anyone's radar. It's between you and the insurance company. But we're going to tell you to be a good steward of your bank and pay it back. Okay? What that allows your cash value to do is continue growing as if you never touched it. The beauty of this is that when you start using this for assets, real estate, a business, tapping into the same pool of funds, and it's the capital, it's the revenue from the business, it's the cash flow from the tenant that's paying back this account. And at the end of the day, the whole idea is that this is going to serve as your tax-free source of distribution income. Okay, this is going to supplement any other income you have on a tax-free basis, and you're never going to pay it back because that's the whole strategy. Okay, so if you want to know more, let me know. We can talk about it. When you control your income, you control your outcome. Thank you for listening. Till next time. All right.